All right, good morning, everyone. And we're going to go ahead and jump in and get started. And this is lesson 2 of 5 lessons, Introduction to Real Estate Investing. Today's lesson is probably a pivot lesson. In other words, the content and the subject matter, if you don't have or do this, then you are almost guaranteed that whatever return on investment or capital or profit that you would have in real estate investing will be cut at least by 50% or more because of the overexposure to the tax implications, but more importantly, the financial attributes and just the weakness of the return on capital. When you invest your capital in getting a return and being able to measure that return, you've got to measure it in pre-tax and post-tax, but also you've got to look at the inefficiencies of why these attributes might be contributing to your ability not to retain or keep more of that capital, and what are the driving forces. The biggest driving force is in how you set yourself up to begin with in the path of real estate investing. You're going to learn this morning in the objective of this particular lesson that there are a myriad of ways that you can set yourself up in real estate investing to address the financial attributes as much as the tax attributes. A failure to do that, which is fine, will severely and significantly limit your ability to get a fair return on capital, and will almost undoubtedly always overexpose you to unnecessary financial loss, weakness, or taxes, or all three. So the breakdown today that we're going to dive deep into is the structure under which your real estate investing is taking place, the unique character and tax attributes of each of those structures, how you set yourself up to do real estate investing, and what the rules are, the rules of the road, and what the IRS requires in the event that you get audited. And keep in mind, and I'll have a little bit more to say about this because we're going to take a little bit of a guided tour of the back office, in your back office, and how we're building that out. It's important to keep in mind that the IRS annual budget is about 33 billion, and they just 2 pieces of legislation now in place gave the IRS an additional $142 billion. And they have a hiring initiative of 87,000 new agents. They've already started well into that. And their targeted initiatives, these are specific areas that the IRS is now focused on. Among the 24 of those initiatives, you have real estate agents and real estate investors. These are target initiatives that the IRS believes and sees a great opportunity to collect hundreds of billions of dollars over the next 10 years. And the IRS started using AI back in 2019, and they just expanded. They're in the process of expanding their artificial intelligence capabilities by $100 million. And over the next 3 to 5 years, you're going to be seeing the IRS rapidly ramp up the integration and use of AI, basically tracking taxpayers in ways that we never even thought were possible. So I'll have a little bit more to say about that toward the end. So let's jump into the basic overview of the illustration of the different structures. The management structure, which is the one that we prefer. I think I've been using this particular structure with clients for at least 20 years. It's not a new concept. It's very well established. There's a lot of tax court decisions pro taxpayer winning and a few of the taxpayers losing. And we know why they lose, because they don't do a few things that I'll be talking about that give us the opportunity to meet those tests. That management structure gives you an important opportunity to maximize the financial and tax attributes of your real estate investing. So in our learning objective, basically, it's really designed to define the types of property, the types of modeling, and the entity of choice and how that structure would be set up, and then how to make certain tax elections. For example, I'll talk a little bit about the Section 469 grouping election and why that's a significant part of your overall planning strategy in terms of your real estate investing. At the end of the day, the purpose of investing your capital is to get a return on that capital while you're managing the risk exposure of investing the capital. You don't want high risk, you want managed risk, but at the same time, you have other risk factors that come in through the financial and tax attributes that, if you aren't aware of them, these hidden risk factors can deplete your capital by more than 50%. So what you thought you were going to make on a deal, you made that, but by the time you have to pay tax, it was half or less than what you had anticipated. And the reason is because you didn't have a plan or a structure that addressed the financial and tax attributes. So that's why this lesson, I think, is a pivot lesson. It's very important in terms of the overall objective. So when you're investing in real estate, we're going to talk about the various ways that you have available. In other words, these are your different choices. You can decide and choose to invest in real estate in any one of these ways. These are the most common. And once you decide how you're going to invest in real estate, the die is cast, because that's how you're going to be taxed. It's really not complicated. It's like two sides to a coin. When you decide how you're going to invest in real estate, that decision decides how you're going to be taxed when you do invest in real estate. And so we want to look at the structure, and we want to look at the different ways that how you can invest, because they all have certain character or characteristics and attributes that give or lend themselves to a reason why you would or why you would not invest in real estate in this particular way. And that's the real purpose of this lesson, is to really navigate you through all of those hazards of the different ways that you can invest in real estate, so that you're aware of them and you can come to the conclusion that perhaps you might do a little bit of reorganization planning and reorganize how you're investing in real estate, so that it is more congruent and in line with keeping more of your capital with less tax exposure. So you can invest as an individual investor, what we call a sole investor. You can invest as a married couple and do that by making an election as a marital joint venture election. You can invest as a single member LLC, which is a disregarded tax entity in the eyes of the IRS. You can have the LLC, but it gives you no unique tax attributes because the IRS doesn't recognize it. You can invest as a managed member LLC. You can invest in real estate through a C corporation, which is a regular corporation that has not made a special unique S election. Or you can invest in a real estate transaction through an S corporation, which is a C corporation that was formed and then it made a special S election to be taxed as an S corporation, as a pass-through. You can invest in real estate as a general partnership with 2 or more partners. And you can invest in real estate as a limited partnership where you have at least one general partner and at least one or more limited partners. All of these ways in how you invest in real estate set forth how you're going to be taxed. They have unique financial attributes and they have unique tax attributes. I'm going to hit the highlights and give you my opinion in terms of my experience in working with investors, as well as what my wife Susan and I do as investors in real estate ourselves. And we've been very successful over the years because we understand that how we set that transaction or that investment up really is going to decide not only the holding period, but how much we're going to be able to keep of that investment. And at the end of the day, it's really not as important about how much money you make as much as it is how much of that money that you made that you get to keep. If you made $100,000 on a real estate transaction, but you've got to give half of that up in taxes because you had no planning or no formal structure, then your return on capital and your return on your investment is weakened by that overexposure that you have to the tax impacts. The basics of entity organization, and the lesson plan is up in your back office. I think the biggest and most important part of this, again, is how your investing activity in real estate is going to be organized from a legal, financial, and tax perspective. It's within this lens that we look to your activity and involvement in your portfolio, your real estate portfolio. If you have 2 or more real estate properties, you want to pay particular attention to today's lesson because there are some new nuances that we want to address that give you some additional planning opportunities that will allow you on any future disposition of the property, let's say a sale, it'll allow you to keep more of your money and not be overexposed to the risk of excess tax. This is very important in terms of the planning attributes because setting forth a plan really is half of the process. But if you don't execute on the plan, then it's just an idea. And so we want to make sure that we've got a good path to execution. All right, let's jump in. And I'm going to have John monitor the chat just in case when I take a little break here and I have any questions. Pop your questions if you want in the chat, or I'll open up and invite any questions. I'm going to try to go through a couple of these and then we'll take a little break and see if we have any questions as I work through each part of it. The first one is the individual investor, or what we call the entity composition, the sole investor. You can have a husband and wife that are married, but you could still have a sole investor, the husband or the wife. And those are nuances. Maybe that the property existed pre-marriage. Maybe there's a marital settlement agreement from a divorce, or maybe you have a separate property agreement for tax planning. So there's always these combinations of facts that you could have a sole investor status. That's basically one person that owns one piece of real estate that's an investment real estate for rent. It's not a primary principal residence that's being converted. So that individual investor structure and its composition as a sole investor gives us basically the die is cast in the tax character of that transaction. It's going to by default be a passive activity. The losses are going to be limited, that you're allowed to deduct no more than $3,000 per year against other passive income. If you had $25,000 in losses because of depreciation and other factors, won't matter. You're only allowed to deduct $3,000, and that has to be applied against any other passive income. And if you've eaten up all the passive income, then the maximum that you're allowed over that passive income is $3,000 per year. So it's a very restrictive, and it's by default of the statute. So this is a statutory composition because the statute defines by how you hold the property. The statute's going to define how you're going to be taxed on that property for federal tax purposes. And with some minor exceptions, there's not very much difference between all of the states. There are some nuanced differences for states like the Socialist Republic of California and New York and Illinois. They have some little nuances, but we're focused right now for the main part in federal taxes. The organizational structure is very limited, provides for no planning options, and it's probably safe to say that the highest level of tax exposure is in this particular way of holding property. You're going to be absolutely taxed at the highest level, both for capital gains and ordinary income or passive income down the road on a disposition. You're going to be recapturing all of the depreciation under the tax benefit rule. So if you made $100,000, but you also claimed $100,000 of depreciation, you now have a $200,000 tax recognition event because you have to recapture all of that depreciation, whether you claimed it or not. And that depreciation is going to be taxed at your ordinary tax rate, not at your lower capital gain rate. And the current administration is proposing doubling those taxes after the election. If the Biden administration continues forward, the proposal is to double those capital gains and ordinary tax rates on real estate investing. So that's pretty hostile when you think about it. I don't think in the last 40 years that I've been doing this that we've seen taxes on real estate investing that hostile, but that's kind of where the direction is headed. So your return on investment, your ROI, or your return on capital, your ROC, if you don't know how to calculate that, other lessons that we're going to be doing in this series are going to take you through, because you have to do a parallel computation, pre-tax, post-tax, your ROI pre and post-tax, and your ROC pre and post-tax. But suffice it to say, this holding method as an individual, or what we call sole investor, is going to expose you to the highest and most amount of tax. The next would be a married couple electing to be a marital joint venture. Generally, you make this election to avoid being treated as a married couple partnership, requiring you to file a partnership return. Now, there are some big advantages to a marital partnership or a partnership for tax purposes, where we would advise the client not to make the marital joint venture election. And that gets into the individual planning. And almost 90% of the time, it is in the best interest of the client not to make this marital joint venture election, because we want it to be treated as a partnership, because there's some unique planning opportunities on some future disposition of the property that give us an opportunity to do a little bit more aggressive planning, so that if we have this big profit windfall, we're going to be able to keep a lot of that by the planning that we're going to be able to do. And so generally, the marital joint venture would apply to rental properties that pre-existed the current marriage, would be excluded, or maybe would be the new properties that were during the current marriage might be treated under a marital joint venture, or maybe one or two of the properties. It's an analysis that we do because we have to understand what the end game or what the objective of the client is in holding the property, and what the period of time that they're going to hold the property, and what is the investment purpose. Well, in other words, you've got about 6 different reasons why you invest in real estate. And if you haven't defined that, we're going to have a lesson that covers that what is the purpose of this investment? If it's to produce income and appreciated value, then your modeling and your structure better be complementary or congruent to that. One of the most common things that we see is that investors in real estate are wildly separated from reality on what their rents should be and how to compute those rents using a different type of an analysis, a valuation analysis. And so we see investors in real estate not raising rents or rents not keeping up with inflation. And the most common reason that we hear this is, well, I don't want to lose my tenant, so I don't raise the rent. Well, I can understand and appreciate that, but you're each year that you don't raise the rents, you're losing faster. It's a race to the bottom in how fast you're losing money if the investment can't maintain its financial attributes to make it a viable investment. And it's contradictory to the purpose of the investment if the investment purpose is income. Um, I think that at least for the last 5 years on one of our rentals, we average about a 9% annual increase in the rents. After a holding period of 10 years, we've increased the rents almost 50%. You have to look at the financial purpose of the investment and if your activity and your holding of that activity is congruent with that purpose. This is the disciplines that most investors are going to follow. Moving on, we have a single member LLC, which is just the same as a sole investor in terms of the federal tax treatment. There is no distinction with a difference or without a difference. It is disregarded. The entity, for all intent and purpose, from a tax perspective, does not exist. Most people that do a single member LLC are in the belief that they've got to do that for liability protection, yet their operating agreement doesn't have some important features. And in any litigation, that's going to be the first thing that's going to be subject to discovery by the other side that's suing you. And if that operating agreement doesn't have these provisions, then it's not going to provide the type of protection, and it's going to be able to be, the veil will be able to be pierced. And if you want to solve that, probably the more effective, cost-effective way to solve that is a good insurance policy with a good umbrella policy so that you have more than enough insurance to address any legal issues that are not going to be coming after you personally, unless you're just grossly negligent in something that, would subject you to personal liability. You need to talk to a real estate specialist in an attorney that has this kind of understanding. Every state's a little bit different, but good coverage and good entity structure, those are going to be the things that save you and protect you now and in the future. So single member LLC, you're still going to be treated for federal tax purposes as a sole investor. The next one is the managed member LLC. My preference, the entity composition is the managed member. And this is where you get into a little bit of the advanced planning, because this really gives us a lot of bandwidth and a lot of things that we can do once we have a structure that is complementary to this objective. We have basically a departure into the possibility of doing a lot of current and short and long-term planning that gives us a huge menu of things that we can do. And this is why I prefer this particular structure, because of all of the opportunities that affords us in terms of planning, both today and in the years ahead when we're going to have some future disposition. Then you have the particular holding where the property is owned by a C corporation. Every corporation is formed and its entity life begins as a C corporation in perpetuity until you dissolve the corporation. So it's going to last forever. You would want to make sure you have unique tax attributes and elections on the stock of the corporation so that it's qualified small business stock. Is it a stock sale? Somebody's going to buy the stock of the corporation and the corporation owns the real estate? Or is it an asset sale where the corporation is going to sell the real estate and keep its own stock? Those are going to decide how much money you're going to be able to keep at the corporate level. Corporations, C corporations, generally, unless you have some unique planning opportunities, they don't lend themselves favorable to the most preferred. Now, they are preferred for development and they are preferred for rehab and flipping. There's a couple of unique things that we look to depending on what your real estate activity encompasses. So they're not off the table. They're not the first or primary entity structure of choice or entity composition of choice. Next, we have an S corporation, which is the only distinction with the difference is that it's a C corporation that made a unique special S election using Form 2553 under the Internal Revenue Code, Subchapter S. And this was established during the Eisenhower administration, basically aimed at family farms and small businesses after World War II, and all of the reformatting of our economy that allowed this unique attribute so that you could have the protections and the benefits of a corporation, but not have all of the tax consequences because your profits wouldn't be subject to self-employment tax. They would simply pass through to the shareholders as a pass-through entity like a partnership and not subject to self-employment tax. We have a long history of decades of litigation on these issues. S corporations are also a target initiative now of the IRS, and people with S corporations probably have a much greater risk now of being audited in the years ahead because there have been a lot of abuses about not taking reasonable compensation and bundling up what would otherwise be classified as personal expenses, characterized as corporate expenses when they're not done under some accountable plan or something like that. So we see them as problematic for the future, but they are viable in using for a management conduit, which I'll be talking about in today's lesson and setting sort of the framework of how that works. All right, then we have the composition of the general partnership entity structure with 2 or more partners. And these are very, very, very preferred entity composition structures because they give us, depending on other factors, they give us some unique opportunities to do some additional planning for those partners. Are the partners related by business, marriage, or blood? Those are the 3 relationship tests because we have special rules that if you're a related party and you own 2% or more or 10% or more of an entity, then you've got to be aware of these entity and these related party rules. Partnerships also give us some opportunities to do unique planning with the partnership interest. The partnership owns the real estate and you own the interest in the partnership. Are you selling? Is the partnership selling the asset or is the partnership selling the interest? In other words, are the partners selling their interest in the partnership that owns the real estate? Or is the partnership selling the real estate, keeping their interest in the partnership, but getting rid of the real estate? All of those things go into the mix or the batch, if you will, of what we have to take into account in terms of the planning and what tax implications that we have to be aware of both now and during the holding period and on some future disposition. All right, then we move to the entity structure of that of a limited partner with the composition of a general partner, at least one, and at least two or more limited partners. And a general partner can also be a limited partner with another partner. And a partner can be an entity, a corporation, or a partnership, or an LLC, or it can be a natural person. It can also be a foreign born person or a foreign entity. Now, that gets a little bit complicated, but if you have a US citizen married to a resident alien of another country that is not seeking to have US citizenship status, you've got some unique planning opportunities where this kind of structure and composition might lend itself very well to making a lot of money and not having to pay much tax on those profits if it's set up correctly. And so I would just invite you that there's always a way in which, once the structure and composition is set up, there's always a way to navigate the tax code and keep more of your investment and profits, as long as you understand that you have some duty or obligation to make sure that your entity structure is congruent with your investment objectives and keeping more money. All right, so at this point, what I'm going to do is just pause for a moment. And if we have any questions, let me just get one little click here. Hold on just a second. If we have any questions, I would invite you to go ahead and ask those questions right now. And I'll take a minute to go ahead and answer them before we move forward. Chat here, hold on. Doesn't look like we have any questions yet. All right, so moving forward. Let's talk about a grouping election, what we call the 469 election, and why it is important, because there are some basic rules when you're investing in real estate that are going to decide, based on your activity, whether your activity is passive for tax purposes or whether it is active, ordinary and active. And this distinction is important because it addresses not only how you're going to be taxed, but the character under which your taxes will be ordinary tax or passive. And depending on other factors, this can actually cost you a lot of money when you sell a property and you have a nice profit and gain, only to realize the next year when you file your tax return that you're going to be giving up more than half of that in the taxes that you're going to have to pay. I'm a little bit critical because a lot of professional tax preparers, let's say, just simply don't understand and do not have the expertise, the knowledge, or the skill, or the credentials in real estate taxes. They're great people, great men and women, I'm sure, but they are really in over their head by not having this kind of expertise, and they're not serving their clients, in my opinion. Because of those restrictions and limitations, the clients are always going to be overexposed to tax. All real estate activity for tax purposes and reporting by default is passive unless and accepted if you've made certain elections or exceptions to the rule based on how your activity is conducted. And we're going to get a little bit into the weeds on that today. Passive losses offset passive income. They don't offset ordinary income. Passive losses that are greater than the amount of passive income may not be claimed over the statutory limit of $3,000 per year. If John has 50,000 in passive losses and has 30,000 in passive income, then John takes his passive income of 30 and subtracts the 50. That leaves a net of 20,000 in passive losses that he gets to carry forward, but he ends up with zero income for the tax year and a $3,000 passive loss for the same year, leaving him 17,000 in suspended passive losses for the rest of his life. They carry forward to the next tax year. And I rarely see this computation calculated correctly on a tax return of a new client that has this situation. And we have to go back and reconstruct those losses because, again, the limitation of their tax preparer, they don't know what they don't know. And they don't track those losses on that property or on the activity. There are 3 rules. These are the 3 golden rules to all real estate activity. And once you understand these rules, you'll see the importance of the composition and structure of how you invest in real estate actually matters a big deal. The Internal Revenue Code requires that the activity must demonstrate that it is an active participation and a material participation. It's what we call the active material participation test, and must demonstrate that you meet the hours test requirement of that of a real estate professional as defined under the Internal Revenue Code. That does not mean you have to have a real estate license. This is a statutory definition in the Internal Revenue Code that defines by your activity and this test that your activity is that for tax purposes of a real estate professional. And once we can meet that test and we have all 3 of the golden rules, we're golden, because now we can do some really cool planning and we can do a lot of things that are going to allow us to keep a lot more of our money both now and in the years forward on some future disposition of the property. The active material participation test is a 2-part test, starting with the active participation, followed by material participation. In other words, that's the order of operations. If you do not meet the active participation test first, nothing else matters. We don't have to go further because you don't meet active, and we don't have to worry about whether it's material or a real estate professional. Even if your activity were material and you met those standards, and you did meet the standards of that of a real estate professional, because you didn't meet the active participation, you will fail the test. I have done a number of IRS audits for real estate investors, and I've done a number of appeals of audits that people have lost on real estate investing. And there is a significant focus on this area by the auditor. They're actually specially trained in these areas. And it is a bit exhausting, the nonsense you have to go through to establish that you have met these 3 rules. The cool thing about this course and this whole platform that you're part of is we're going to make that part very easy for you to always meet. And we're going to make it very easy for you to know the minimum things that you have to do. And if you do those things and you do get audited, bam, we're golden. You're going to win. You're not going to have the exposure that most people have because they don't know what they don't know. And that's kind of cool. So I invite you to read the lesson, and then there's stuff up, and we'll take a virtual tour of the back office, because we have all of these standards. We're even giving you a copy of the IRS Audit Techniques Guide on rental real estate, so we can tell you right in that guide, the IRS is going to tell you exactly how they're going to audit you. Because remember, real estate investors are now a special initiative of the IRS. Let's just call it a target. And we're going to see a lot more real estate agents and real estate investors, particularly small investors, getting caught up in these new initiative audits or special focus exams. So these three rules to real estate activity sort of set forth the path that you're on, both now and in the years ahead, in terms of how you're going to be taxed and how we can maximize the tax attributes to your benefit so that you're allowed both now and in the years ahead to keep more of your valuable money, your capital. Losses from any real estate activity are considered per se passive. It's a legal term of art, per se passive. They cannot be offset against income from non-passive or ordinary activity, like your paycheck or other ordinary income. A rental real estate activity of a taxpayer who qualifies that of a real estate professional is not per se passive. It is statutorily active because you've met a statutory test. That's an important distinction. And to be considered a real estate professional, the taxpayer must provide that more than one half of his or her total personal services in real property, trades, or businesses in which he or she materially participates and performs more than 750 hours of services during the tax year in real property, trades, or businesses. If you can do that, assuming by default that we've met the active already, then ideally taxpayers should prepare the contemporaneous time records that detail the services that are rendered. And we'll talk a little bit about that today, but that's why we're doing these lessons, because we're going to give you the safe harbor and all of the minimum things that you need to do. You need a calendar on your computer, a day planner, and a couple of things that you do when you do them that you make notations of. And if you do that, you've created the record, the contemporaneous record, if you will, that will allow you to prevail if you're ever audited. And preserve the status, because remember, it's that status that's going to give you the tax benefit today and tomorrow. There is no, I can't think of any reason why a person would want to say, oh, I'm just going to do this as a sole investor. I'll worry about that later. I'm going to make $150,000 profit on this property. Yeah, you're going to make $150,000 profit, but you're going to pay $75,000 in tax when you're done making that profit, and you're not going to have 150. You're going to have 75. And you probably won't pay that on time, so you'll have some penalties. You probably won't file the tax return on time, so you're going to have some more. I mean, it starts spinning out of control pretty quick. That's the discipline that we're talking about as a real estate investor, and you can't be guided by emotion. You got to be guided by facts. And these are the facts of what we've got to do to meet these minimum standards in order to have the most favorable tax treatment and financial treatment. Passive activity rules and material participation is very important. To avoid the classification of an activity as being passive, you have to be engaged in the rental or real estate business and overcome those two hurdles. The taxpayers must establish that they qualify as a real estate professional by the facts and circumstances surrounding their activity. Basically, if you have a calendar on your computer and you have a rental property, do you record on your calendar when you're doing work of any kind related to each of your rental properties? If you're not doing that, you're not creating a contemporaneous record of your activity, and you're risking failing this test. So something as simple as writing it on your calendar and having a day planner to record, I went to my rental property on Beach Street today to show a new tenant, and it's on my calendar. Awesome. You are golden. You've created a contemporaneous record, and you have met the active and material participation. Bam. done. And you've got substantiation. How much time did you do that? Going, being there, and coming back. How much time did you keep track of that time? When we get into exams and audits and appeals of exams and audits that other taxpayers have lost and we get referred, we have to reconstruct these records. That's the second best standard, reconstructing the records. But it can be frustrating and burdensome and annoying because we've got to go back and figure out from a lot of different collateral evidence rules, receipts and this and that, and reconstruct a day planner and reconstruct the count. I mean, we can get there, but it's more time and more money that you would save if you just did that one little thing to begin with. In order, we're doing this in order to avoid this general rule that the rental activity that we're engaged in is a per se passive activity. Material participation is different than active participation. And this is usually where taxpayers fail the test, is because they cannot meet the material participation standard. Section 1.469-5T, temporary regulation A, under temporary regs, provides that a taxpayer can establish material participation in an activity by satisfying one of any of the 7 tests. Only one. You don't have to get them all. If you participate in the activity for more than 500 hours in the year and you have time records, you're golden. If the individual's participation for the year constitutes substantially all of the participation in such activity of all individuals. Well, if you're the only individual, then you meet that test. That's the easiest one to meet. You also have a 100-hour test. I like the 100-hour better than the 500-hour. Okay. So read through these at your leisure, because our job as trusted advisors is to help you find one of these, the easiest one, that you can meet and give you guidance on what you have to do to substantiate that you're meeting that, so that if you ever do get audited, you have the high confidence that you will prevail in that audit with a no change, and you're not going to have a problem. We can't do anything about that except guide you and make sure that we're looking at the stuff to make sure that you're meeting that basic test. And that's why we're here, for that support. All right. Also, material participation tests that are under the temporary regulations. There's a little carve out regarding the 7th test. And this, I think, came about as a result of one of the tax court cases. But basically, the short of it is the facts and circumstance test that the taxpayer must participate in the activity for at least 100 hours. Under the temporary regs, the taxpayer services performed in management activities are not taken into account in determining whether he or she materially participates, unless no person other than the taxpayer receives compensation for those services, and 2, no other person performs management services for more hours than the taxpayer. Pay attention to this, because this is a big deal. When we advise a management conduit corporation that's a managing member of an LLC, and you're getting a paycheck from the corporation for your rental activity as a management activity, and no other person is receiving that compensation except you, and no other person except you is performing that management service, you've met this test. And when that LLC sells that property and you have your $200,000 capital gain, you're not going to pay any tax on that capital gain, because you have this set up as a management conduit. This is a big deal. And this is what Susan and I have been doing for many years, and successfully helping other clients do the same thing. And now that IRS has a special initiative on real estate investors and real estate agents, you might want to really pay attention to this particular section, because this is the nexus of all of what we're doing in the organizational structure and planning. All right. We want to talk a little bit going back to active participation because that's kind of an important distinction. You can be eligible as an active participant in real estate if you own 10% or more of the rental activity and you have a significant involvement in the management of the rental property and are not a limited partner. Well, you're there when we set it up the way that we set it up. And as long as you meet that, your activity meets the active participation standard. The other part of that test, and the alternative would be when active participation in real estate, you can be eligible to deduct up to $25,000 from your real estate and passive losses. Beyond $25,000, you're limited. Well, I don't really particularly like that, so I want the active participation, but I want ordinary loss treatment. And that's why we look at the real estate professional, because once you meet the real estate professional standard, then all of your losses are ordinary and there's no limit to that. When the adjusted gross income is over 100,000, then the allowance is cut in half. And when the AGI, adjusted gross income, rises to 150,000, then the allowance goes to zero. So I don't like that part, but I can do the first part, and that's the important distinction. Material participation includes any one of the following. You can go ahead and read through that. The activity is that of a real estate professional based on any one of the following, and I've highlighted a couple of things. The election may be made in any year in which the taxpayer is a qualifying real estate professional. And a failure to make the election in one year does not preclude the taxpayer from making it in a subsequent year. So that's an important distinction, because sometimes if we're amending tax returns, the taxpayer didn't know that they had to make this election, it's not going to preclude them going forward. In order to qualify for the test of a real estate professional status, you must meet these two primary requirements: devote over 50% of your personal service time to real estate trades or businesses. So if you have a corporate management conduit, that's a trade or business, and engage in at least 750 hours of service within real property trades or businesses annually. That's about 15 hours a week times 52 weeks, and that's how you get up to 750 hours. You can get there pretty quick, but you got to keep some record. All right. So now I want to dive into a structure, what we call a management conduit structure, where you have a corporation and you and or your spouse are the shareholder who owns 100% of the stock of the corporation. The corporation in this particular example would make a special S election to be taxed as an S corp. Then the corporation becomes a member and owns a membership interest in an LLC along with you and a spouse. So the LLC is owned as a managed member LLC. The corporation owns, let's say, 10%. It has to be at least 10%. And it has to be more than 2%. And you and the spouse each own 45% of the LLC shares. The LLC is going to be taxed as a partnership. So you have a managed member LLC. The LLC disproportionately allocates the losses and profits to the corporation at 90%, and the corporation's only a 10% owner. Well, under the disproportionality rules, you can do that with an LLC. You can't do that with a partnership. You can do it with an LLC that's taxed as a partnership, but it has to be an LLC. So 90% of the profits and losses flow up to the corporation and pass through to your personal return. That's kind of cool. And that becomes important down the road on some future disposition. The LLC in turn owns the underlying rental property. The LLC owns the rental property. On some future disposition of the property, is the LLC selling its shares that owns the real estate? Or is the LLC selling the real estate? And let's say your $100,000 profit comes into the LLC, but 90% of that gets paid up to the corporation in management fees. Now you can take that out in accountable reimbursements, which are non-taxable, other corporate benefits that are not taxable, maybe some salary and wages that is taxable. Put some in your retirement planning. Pretty soon you don't have a taxable event because it all came back up into the corporation and it passes through to your personal return, and you don't have any self-employment. I mean, you have a very different economic model. In summary, the corporation is owned by the investor. The LLC is owned by the investor and the corporation, thus creating a partnership. And the rental property is owned by the LLC. That is the order of ownership. Some of the needed items are, we have to go through and make sure the corporate bylaws are congruent with the objective. The LLC's operating agreement is congruent with the purpose, the stated purpose. The tax elections are made. The management agreement between the corporation and the LLC is congruent. The lease agreement between the LLC and the tenants are congruent, and determine the holding period and the asset classification and the asset segregation. And you are now in a position as a sophisticated investor to go make a lot of money and keep a lot of the money that you make in your portfolio as a real estate investor. And the cool thing about that is once you've got this set up, there's very little that you have to do to change it until you get up to either $10 million in real estate assets or $10 million in real estate income in a particular year. There's very little that needs to be done or added to or changed in the composition of the structure. Once you have about $10 million in real estate assets, or you're making about $10 million in income, then you would need to do a little bit more advanced planning, but not that much in terms of making sure that we've got that next level of income and asset value protected with some other parts of the tax planning process. All right, I'm going to take a little bit of time here and just go through the chat and see what we got. Can we get a copy of the recorded Zoom? Yes, it'll be in your back office. You just log into the back office. And if you're not a member, hold on just a second here. Let me give everybody the link if you have not joined. It's 100% absolutely for life, 100% free. You never have to pay. And I'm going to explain some of the benefits. And you would join by going to that link. And you have access to lesson 1. It was 2 weeks ago, and you have access to all of the lessons. And will absolutely be in your back office, members home. What if my wife and I are performing the management activities? I'll cover that in the next lesson, but let me just suffice it to say both of you would have to meet the material participation, but only one of you have to meet the real estate professional standard, and you can use the time of the spouse in order to qualify for that. So it gives you a little bit of a benefit. And I think that what we want to do is we want to make sure that whatever you're doing, let's make sure that we have the minimum substantiation of you doing it. I don't want to have you go rearrange your whole life with real estate. I want you to just keep doing what you're doing, but I want to give you some guidance in a few things that you should add to what you're doing, like making sure you have a day planner and an electronic calendar so that we're recording our activity. That's a contemporaneous record, which is for legal geeks, that is the best evidence rule. A record that you write today when it happened, not one that you write a year from today, is the best evidence rule, and the IRS is forced to basically accept it because it is a contemporaneous record. Records that are reconstructed don't have the same weight that a contemporaneous record. They're still valid, but they're not given the same weight that a contemporaneous record, something that you wrote when it actually happened, is going to be much more likely to be accurate in reflecting that. So take an opportunity to go back into your back office, and take, just go through that, looking to some of the things that you would have, and I would suggest that if there's a question, just grab the QR code and make an appointment and get on my calendar, and Alan and I will walk you through. There's never a cost for a consultation, and take advantage of, what's the minimum things that you would need to do to meet those standards. There's going to be a lot more in the next 3 to 5 years. There's going to be a lot more activity with the IRS and these special initiatives. They've got a lot more money, and they're hiring a hell of a lot more people. I think the good news in the hiring of more people is that they're not going to be as experienced as the ones that have left and retired. And so we have a bit of an advantage because I got a lot of experience. So if it's one of our clients, I'm happy to do those. But the downside of that, not having a lot of experience, is that you're going to probably get a lot of people that are getting tagged in an audit. And it's sort of unfortunate, but believe it or not, a real estate agent, those are the ones that do the audits. Real estate officers are the ones that do filing enforcement and they enforce the laws. Agents, apply them in like exams and stuff like that. Believe it or not, IRS agents don't really know the tax code as well as you would think. And they certainly don't follow the Internal Revenue Manual, which is their handbook. And so when we're doing audits, most of the mistakes that we find are the mistakes that are made by the agent because they just don't understand the tax law and they don't understand the test. And that gives us a huge advantage to basically give the IRS agent a spanking because they weren't paying attention. And so you don't want to be in a situation where you get an audit and you're not prepared. Okay, if you've got weakness, let's fix the weakness so that we don't have some future issue that's going to pop up. Most of the time, it's very minor, the things that we have to do to shore up any weakness. But, that's what we do a lot of the evaluation for in the analysis, because we want to make sure that you not only meet these standards in these tests, we want to make sure that the activity is congruent with your overall financial objectives in your real estate portfolio. And if you're going to be adding to that, all the more reason that you need to formalize your activity and your engagement in the activity to make sure that you're always in a position where you're able to keep more of your capital, particularly when you're going to be flipping the properties or selling them. You don't want to have to be giving most of that money up in tax. That's unnecessary. All right. I'll keep my eye on the chat. Let me just stop for a minute. I want to start and take us on a short little virtual tour. And give me just a second to change screens here. And let me start with the basic landing page. That's the link that I put up there. Basically, if you haven't joined, the link is in your chat area. You can copy that link, and this is where you go to join the program. It's free for life, and it's going to have a lot of cool material, reference material, some free books, all kinds of cool stuff, particularly in real estate. And this is the page. You can share this with all of your associates and friends, family, anybody and everybody. It's just absolutely a cool deal. We're going to have a lot of, and it's really a mentoring and coaching combination. but also an education platform that gives you the straight shoot on how to do this and how to do that, so that you have the resources and the tools necessary, which we're going to take a little virtual tour here in a minute and show you how that part works in your back office. You can go through and read. John did a great job on designing the content here. Absolutely, again, without question, 100%, without exception, free for life. Got a bunch of FAQs. And again, a little QR code to make an appointment if you have any questions. I think the cool thing is that you've got a place now that you can go and you can get the support as a real estate investor that you need, and you don't have to risk guessing. You're going to get the straight answers that you need right now, and as it applies to you. And that's the most important part. Once you're in and you are in your back office, I just want to show you the navigation in your back office. And let me share my screen. You've logged into your back office. And again, this is where you go to make an appointment. Just grab the QR code, get on my calendar. I'll cover the block of time in our world famous IRS protection plan. Basically, you're going to have the ability to toggle. And we're going to be adding these other programs. The home-based business is another program you can toggle over there and take advantage of access to all of that content. We're adding cryptocurrency. We're adding retirement planning. We're adding business entity planning, and we're adding business planning. So you'll be seeing in the next couple of days those different toggle buttons where you can toggle back and forth. They're going to have lessons just like this. They're going to have tools. They're going to have access to all of the different things. If you need to know how to do a accountable reimbursement plan, you just toggle over to the entity planning for your corporation, and you can download a free accountable reimbursement plan and take the lesson and learn how to put. Look, you don't need me to do that. I'm happy to do that. You can buy a block of time for that, but we're going to give you the tools where most of that stuff you can do yourself. And to the extent that you need help, when you get it, the block of time is 60% less than what our firm rates are. So buy the block of time, 2 hours, 4 hours, or 8 hours. It's going to be a lot cheaper. And then we can focus on the stuff that you need. And I'll show you how that works. Whenever we have a live event, it'll be in that section, that business enterprise section, like for real estate. You know, it's right here. You just toggle on there and you can sign up for the free live lesson like today. Every other week, until we get through all 5 lessons of real estate investing. But we're going to have more lessons on real estate, like flipping property and rehabbing property and the tax attributes of cost segregation, how to use real estate in your retirement planning. We're going to have all kinds of lessons that are going to be available. And when you're in your back office, you can go right down here and toggle through to your courses. Like there's lesson 1 that we did 2 weeks ago. Lesson 2 will be up, I think, later today or tomorrow. Downloaded library. Here's your lesson 1 syllabus. Here's lesson 2 syllabus. You can print it out. Here's your active material participation test. Here's the IRS's passive activity loss audit techniques guide. This is telling you from the IRS how they're going to audit you in real estate. Be good to have that. Here's the premium sale of rental property. If you don't want to pay tax on the sale of your property legally, you might want to read this, because this is the kind of planning that we're doing. Some 2024 tax changes that went into effect. The National Association of Realtors settlement fact sheet on that recent lawsuit that's going to affect real estate agents all over the country. These are all things that are going to be important to the real estate curriculum here. And again, you're going to have all of your lessons that we record and access to those right here. Lessons usually run about 60 to 90 minutes with a little bit of Q&A. And so we try to keep that part very simple. All right, now let me just navigate one next step here real quick. as we're doing this virtual tour. And I want to show you a little bit about when you're logging into your back office, you have access to the blocks of time, and you have access to the IRS protection plan. And so let me just get that up and show you real quick. Okay. I am a little bit technologically challenged, but John has been doing a great job helping me figure out a lot of stuff I don't know how to do. All right, there we go. All right, our world famous IRS protection plan. If you're an individual and you don't have rental property or a business, it's real simple. It's an annual enrollment. It's $97 and you're good to go. You get any notice. I don't care if it's an IRS audit, a collection notice, a non-filing notice. It happened for tax years back in 2012. Any notice, a birthday card from the IRS, we will represent you at no cost. At absolutely no cost. We will represent you because you're part of this program. Now, if we have to reconstruct records in course of representing you, then you're going to have to buy a block of time of 2 hours or maybe 8 hours to do that, but you're going to save about 60%. The cool thing is about half of the cost in anything dealing with the IRS is in the representation. And so the cool thing is you never pay for the representation. It's an annual enrollment fee. If you have a rental property, or if you have a business and or rental property, then you want to enroll in the business, and we'll give you the personal as a bonus and a benefit to that. And that's only $197 a year annual enrollment fee. And again, any notice. And if you just got a notice, go ahead and enroll and we'll still represent you. The point here is that you've got a solution in case you get any notices. You got more agents at the IRS. They've got a lot more money and they've got a lot of target initiatives, and a lot more people are going to get notices whether they realize it or not. And so we're trying to get ahead of that before it starts becoming a big problem. You can read all of the features and benefits in your back office on the IRS protection plan and what it covers. It covers just a vast amount of stuff. Look at all the different notices these are 90% of all the notices are on this page right here. And if you get any of them, then you're golden. You log in, we'll show you how to file the claim, get everything taken care of so that we're on it and we're representing you immediately, getting rid of the problem. And that gives you a little bit more of the peace of mind, if you will, in terms of any IRS notices that you might get. I think at the end of the day, what you've got to ask is, what am I doing, or what do I want to do in real estate? What is the purpose that I'm investing in real estate? And what is the structure and the holding period? How am I going to set it up? And how long am I going to hold it before I do the next thing? If you have answers to those questions, then you're golden. You're good. All it is now is a matter of doing more of what you're doing and fine tuning to make sure that we don't have any inefficiency and that we are keeping a lot more of our money because we're set up the right way and we're filing and reporting and we don't have any issues. And if we get audited, not a big deal. We're just going to respond to the audit and we'll go through all of the issues that the exam might have or the agent might have. Most of the audits that we do result in either a no change or a refund. A small percentage, about 10%, there might be a little bit of an adjustment, but it's significantly lower. I don't think we've had an adjustment of tax more than $2,000, maybe $2,100 in the last 5 years. Most of our audits result in a no change, even if they're not our client. Unfortunately, a lot of tax returns just miss the mark, especially on real estate investing. And unfortunately, the preparers that are doing those tax returns simply don't know what they don't know. They should actually be taking this class. They do a better job for their clients, I think. And the problem is that real estate taxes can be a little bit wonky and complicated. If you've got property that you're holding for long-term appreciated value, and you've got other property maybe that you're flipping for short-term gain, then you're going to want the same corporation, but you're going to want two separate LLCs, one that's flips and one that's holds, because the tax treatment and the tax attributes are very different between those two and what we would do or what we would be advising you to do, and being able to meet or keep the records to meet all of the active material participation tests, and that is of a real estate professional. So at the end of the day, the program is designed to give you all of the great content, all of the tools, and all of the support that you need, and be able to address any issues that you might have should you fall victim to an IRS notice. Not a complicated deal. So now that we're adding and rolling this out, and we've been working on this for several months, our job now is to just get in front of as many people with this great program and help as many people do the same thing that you're trying to do. Make and keep money in your real estate investing. I'm excited when we get into the retirement planning, how we can take our retirement plan and use that as a vehicle for real estate investing. There's just some really cool stuff that you can do. Pay attention to the election. I'm not going to get political, but if the Biden administration continues, the goal or the objective stated last week by the administration is that they want to double the capital gains tax on real estate investing. And they want to tax investors in real estate in a very, very, very different way. What I refer to as a very hostile way. You take the capital gains rate at long-term capital gains at 20%, and you get taxed at a lower rate than your ordinary rate, and you double that to 40%. And you double corporate taxes for C corporations, we're going to have several million people out of a job. And it's going to affect employment, I think. And I just don't think that that's a very good policy. But we should at least know that that's the direction that some people are thinking. Tax policy is guided by legislation in Congress and the Senate. And once they pass the law and the president signs it, it goes into effect. A lot of stuff that was done during the last administration expires at the end of this year. So you're going to see an automatic increase in the tax rates. Everybody in America is going to get a tax hike starting January of next year. If you don't have a plan for that, you might want to think about doing that, getting a free consultation, and let's look at where you're at, so that if you've got any weakness, we can sort of shore that up. And then I invite you to go back and read the block of time, how that works, and the audit protection plan for the IRS notices, because you have the peace of mind, at least knowing that if you do get a notice, you've got people that are going to be able to help you. All right. With that said, I'm going to take just a few minutes here as we wrap up and answer any questions that you might have on today's content or anything else. Maybe you have an investment question about real estate. I can tell you that the market is radically changing, and we only have to look to the market to give us an indication of where we're going to be in the next short 3 to 5 years. I think that we're going to see a tremendous amount of baby boomer decoupling from real estate, but not in the sense that most people might predict in terms of selling. I think we're going to see more buying. Boomers have most of the cash. They have $110 trillion of wealth. About 60% of that is divided between retirement and real estate. If they're selling their personal residence, they're going to be selling at the peak of the market at the top, and they're going to be buying for cash rental property. And that's we're doing a lot of work for clients in that very scenario. They're getting into crypto with the ETFs. You're going to see a lot more of that. That's one of the enterprises that we're going to be rolling out, is the cryptocurrency. 8 ways you can be taxed on crypto, how to use crypto to fund your real estate investing and still not pay any tax, and do that part of your retirement planning. So we're really excited about this model. and getting this out in front of everybody as we continue to unveil it. And I've got John and a lot of people, Alan, to thank for helping us get that there. All right. Let's take any questions. Let's see, we've got Lee, we've got Roy, we've got Kendall and Svilana. Do we have any questions? And then one of the advantages I want to add, by attending the live event, you get a chance to interact and ask these questions. And the questions that you're thinking, there's probably other people watching it that are thinking the same question. So don't be shy. I'm here to serve you and I'm here to answer your questions. Now's the best time to do that. And as soon as I'm done with this, my wife and I are headed over to one of our rentals to do a little small repair. And I'm putting that on my calendar. I'm putting it in my day planner and I'm tracking my time when I go there, how long I'm there, and when I come back for doing a little repair work today. All right, what do we have? Who wants to ask any questions? John, Alan, Lee, Roy, Kendall. All right. I'm going to assume I did a good job and we don't have any questions. All right, cool. Have a great day. Make an appointment. If you need to get a consultation, log into your back office, hit the QR code, get on my calendar. Happy to spend time if you have questions specifically to something that you need to think about or do. We're happy to take a look at it. Other than that, look for when you log in the back office, either later tonight or tomorrow. John will post lesson 2 up in the back office. And have a great day. And
Thanks,
have a great
James.
week.
Appreciate it.
All right. My pleasure. Take care.